So you're in the market to buy a $350,000 home, you make $35 an hour, and you want to see if you qualify. Well, first, let's go through the 5 variables that are going to impact how much you qualify for. Number 1 is your down payment, because obviously how much you put down is going to affect how big your loan amount's going to be, which is ultimately going to affect your monthly payment. Number 2, your interest rate. Number 3, credit scores. Number 4, your monthly escrows, how much goes towards taxes, insurance, and so forth. And number 5 is the other debts that you have, such as car payment, credit card, student loans. So let's do some math on this. Let's say you want to put down a small down payment, so you decided to go with an FHA loan, which requires 3.5% down. So 3.5% down on a $350,000 loan, after you add mortgage insurance back into it, is going to leave you with a loan amount that's roughly $343,660. That's the amount that you're going to be financing. Now let's just say that interest rates are 7%. And let's say that you have credit scores in the 700s. Well, if we take that loan amount of $343,660 over the course of 30 years at 7%, that leaves us with a monthly payment for your mortgage of roughly $2286. Then let's add another $350 a month for property taxes, homeowners insurance, as well as mortgage insurance. So your total monthly payment would be $2636. Now let's go back to what you make and compare the two. So $35 an hour over a 40-hour work week is $72,800 per year. We take that and divide it by 12, that's $6,067. And typically with an FHA loan, you can go as high as 55% of that number as far as the amount of total debt that you can carry, including your mortgage. Now, sometimes it's going to be a little bit lower than that number, and sometimes it could actually be even a little bit higher. But if we take 55% of $6,067, that leaves us with $3,337. That's how much your total debts can be, including your mortgage and your other debts. So let's take $3,337 and then subtract out that mortgage payment that we just talked about of $2636, and that leaves roughly $700 a month left over. So as long as your monthly obligations, other than your mortgage, and again, that would include car payment, credit cards, personal loans, and so forth, don't exceed $700 a month, then at least on paper, with those credit scores and an FHA loan at a purchase price of $350,000 and putting 3.5% down and escrows at a roughly $350 per month, you should be able to qualify for that purchase price of $350,000. But don't forget, you're not just going to have the 3.5% to put down, you're going to have closing costs as well. Sometimes you can get a seller to pay for that, but it's a lot more difficult when you're in a competitive housing market like we're in today. Just plan for anywhere between 3 to 5% of the purchase price that you'll also have to come up with in addition to the 3.5%, and you should be safe.